Welcome to the daily update. Well, I'll go over the action in the market for Friday, January 5th, and then we'll see how things look for Monday, January 8th. We had a bit of an update. In fact, it was the first update of 2024. We've had solid down days in a row, but it really didn't do much to change anything. We're still leaning more towards this weakness when we look at our charts. Now, we saw volume on Friday below average, even though the employment situation report came out. You could take that as negative. It's like, there's not a lot of participation right now on a Friday after a major economic report comes out. You could also take that as positive in that, wait a minute, okay, the market's having some weakness right now. We're dealing with the 20-period moving averages, and we're not seeing a real pickup in volume. Maybe that could be taken as positive where the smart money wants to wait for a little while. So let's go back and talk about what happened. Right at the open, we had a higher open. There was initial negative reaction to the employment situation report. It came in hot, and that made interest rates go up and futures started to go down. But by the time we got closer to the open, we were actually able to open positive, and prices rose above the daily pivot at 47.01. So we got above the 4,700 level, at least for a little while. We got up to R1 at 47.14, and it looked like, okay, maybe they're going to twist this around and take this as positive and see a lot of buying and take prices higher. Unfortunately, prices then fell back below the daily pivot down to the unchanged level. It tried to find support at the unchanged level, which is that built-in point each day, but briefly went negative. Then prices tried to climb back above the daily pivot, and we fell back down below. It was a very choppy day. We fell back below the unchanged level and closed slightly positive. So we were up 0.18%. Yeah, it's a positive day. It goes in the books as being a positive day, but it wasn't much of a real V bounce after the declines that we've been seeing. So not a lot of damage has really been repaired at this point, and we're still kind of leaning more towards the weak side. We were below average with volume, so we are looking a little bit more weak right now. Technically, the market's a bit confused. We had an employment situation report that came out that showed stronger than expected economic growth. That is freaking out the market. And then we had the ISM manufacturing come out, or was it the non-manufacturing? I'll go through it in a moment here. It came in weaker than expected, and so it's like, we're not really seeing a theme here, so we're not really sure what to do right now. So after hoping that maybe Friday would make things clearer for the market, it actually has made it more cloudy. Of course, we'll keep an eye on the geopolitical events. Those can always erupt at any time. There can even be one that's not on this list that could come in and have an impact on the market. But now that Russia, Ukraine has kind of settled into a longer war, now that things are just kind of going on in Israel, it's not having a direct impact on the stock market anyway. It's impacting millions of people, but that's what we tend to see happening here. Well, something will come out. It'll be the major story for 3 or 4 days. It might go through 1 or 2 news cycles. And then as it kind of settles into this craziness, it kind of goes away from having a real impact on prices as far as the stock market is concerned. Some comments that we can make: it was a very choppy session. We ended up closing down below 4,700. Growth continues to underperform value, and that is a concern. We've been seeing that. We saw that throughout the month of December, even as prices were going up. That was a negative divergence. Now, as we're seeing more weakness coming into the market, we're seeing this underperformance of growth continue. And the S&P is down below 4,700. So that must be important because I have it there twice. We only have our ADX chart as being extreme positive. Now, you could say it's not extreme positive because we've dropped below the moving average. But the green line's still on top. The ADX itself is still above 40. So that's why it's still on this extreme list. We do have kind of a list of extreme negative conditions right now, different charts that are registering this. This includes the Williams percent R, the Stochc RSI, the CCI 14, and the stochastics. You notice the stochastics are off of the extreme positive list. Well, they're just on the extreme negative list now. Intermediate term, we still have kind of a long list. That can include our ADX because it's above 40. The 50-period exponential moving average study, the rate of change continues to be giving us an extreme positive reading. The PMO oscillator and all of our oscillators are rolling over, but they're still extreme. So that's kind of this in-between land right now. The bullish percent index for the S&P and the NASDAQ 100, they are both declining, but they're still extreme positive. And then our new high, new low study based on 10 periods for the S&P, that continues to be extreme positive. We still have the 150 and the 200 periods simple moving averages. Those are still extreme. We're still dealing with this same scenario. Now it's a little bit in doubt that the Fed might be done raising rates. Well, up until this past week, that was the prevailing scenario. And that the idea is that maybe as soon as March, the Fed might even start to cut rates. Well, that's in real doubt right now. And when the meeting minutes came out, it said, well, if these economic reports are stronger than expected, we might have to go back in and actually raise rates. That's being added into the mix right now, and that's producing a lot of this cloudiness that we're seeing. The dollar was down slightly. It actually, during the cash session, it was up. And then when it carried over into the initial session before it closes for the weekend, it ended up ticking down. And then interest rates, we're back above that 4.02% for the 10-year yield. That's according to the chart. I don't have the chart this time. That's when it starts to potentially run into problems with corporate earnings. We ended up closing at 4.04%. The 10 to the 2 and the 10 to the 3 month, those yield curves are still inverted and becoming even more inverted. Sentiment didn't change. It's just a little bit under that 75 level. We came in at 74. We're still positive, but we had become extreme positive, and now it's starting to come back down. Our trend is still positive. The green line's on top, but it is declining. We have a weakening trend because both of our ADX charts, they're falling below the moving average. I've kept I've changed our bias over to mixed just because we had an up day. Not a real gangbuster of a day, but it wasn't enough to really shift things back more positive, and I'm still keeping our momentum at negative. The reports that came out, this was hot. The non-farm payrolls, they expected 162,000. There were 216,000 that came out. Last time it was at 173,000. So that spooked the market right there. That's showing a really strong employment situation. And we even exceeded expectations with the non-farm private payrolls. They expected 132,000. We got 164,000. Last time there was 136,000. The unemployment rate ended up being unchanged. They expected it to tick up to 3.8%. It actually remained at 3.7%. The average hourly earnings were also greater than expected. They expected 0.3% of an increase. We ended up getting a 0.4% increase. Last time it was up 0.4%. The average hourly work week ticked down. It was at 34.3. They expected it to be at 34.4. Last time it did come in at 34.4. Factory orders came in stronger than expected at 2.6%. They expected it to come up 1.3%. Last time it was down 3.4%. And then the other big one, I guess the non-manufacturing PMI, it's still above 50, just barely showing some expansion in the economy, but it was weaker than expected. And this is like, okay, maybe the Fed might cut interest rates now. So between these two major reports, we're getting different messages that are being sent to the market. They expected it to come in at 52.5. It came in at 50.6. Last time it came in at 52.7. Here are some charts. Here are the non-farm payrolls where we did see an advance and it did end up going up more than expected. Here are the hourly earnings where they're also starting to tick back up. That can, at least according to the market on a year-over-year basis, that can be inflationary. The unemployment rate was unchanged at 3.7%. So when we look at all of our charts, we have the initial claims. That's the red line here. And then we have the blue line, which are continuing claims, and then the unemployment rate. When we look at factory orders, we are starting to come back up after they had been negative for a while. So that's showing some improvement there. Durable goods are also above zero and showing an advance. The non-durable goods are still negative, but showing some improvement. And then non-defense capital goods year over year, this is also still above zero and starting to turn back up. The ISM, the blue line is the total where we're above 50, but we are going back up a little bit and the prices are coming down. And this was more market friendly. So if we saw weaker than expected employment situation report and then combined with the ISM services report, we probably would have saw a nice little rally. But because we're seeing conflicting information, the market is confused right now. Then I have some Isabel Net blog charts. Sometimes I'll go through a lot of these charts. Other times I won't go through any of them. I just look through them and say, okay, which ones seem to be applicable to what's happening right now? This is when we look at the S&P 500 during a presidential cycle. This is the monthly average returns going back to 1928. And over here on the left, you can see during January, yeah, we end up being positive. We're up 45.8% of the time, but it's not necessarily any kind of a gangbuster return. And then when the S&P is down at various points, like the first 3 days, we were down. What happens after that? If the year to date is down for the full year, that's this dark blue area. We end up being up 3.8% of the time. And I guess that's the return. That's the price move. And then if we're up, we actually end up doing better than that. Now, after Monday's session, we'll be able to look at the first 5 days. And there's a lot more research that's been done on that. And we'll see what ends up happening there. But we're going to have a pretty solid update on Monday to make the first 5 days be be positive. Because we already have the Santa Claus rally that didn't happen. And then the first 5 days, that's another one of the trifecta scores. If we don't get those, that means we're 0 for 2 so far. The last score in the trifecta is the month of January. All right, then volatility is the toll that we pay to invest. And this just says, how often does a 3% dip happen? And that's, the smaller the percentage, the more it happens. And so there are times when these things do occur. And then it looks at what happens when we have a 5% mild correction, a 10%, and then so forth. And the more the move, the less these end up happening, which only makes common sense. So there are times when, especially if you're long in the market, and if you use the buy on the dips type of approach, you're going to be underwater, and that's going to probably make you a little uncomfortable until things eventually, hopefully, get to the point where you're actually starting to see a profit. Then we look at Deutsche Bank's unemployment forecast and compared with others. The solid blue line here, this is the unemployment rate. And now this came out before the employment report did, but we're still at 3.7% here. And then this is what the Fed is predicting, where the unemployment rate is going to go up looking forward. And then this is Deutsche Bank's forecast. Those are the red dots. And then the Bloomberg consensus. And they tend to be a little bit more pessimistic as far as the employment situation than the Fed ends up being. And then we look at Deutsche Bank's inflation forecasts, where they are tending to see it go down a little bit more than what the Fed is actually predicting. The important takeaway from this that I'm getting is that we're seeing this going down. It's like forecasts, well, some are right, some are wrong, but the idea that all of these are headed down tends to be more positive on the inflationary front. All right, let's look at the intraday chart, where we did see not a real big open to the upside, but so we were pretty much flat, but we were positive, and then we got above the daily pivot. We made it above R1, and we stalled out right at that level. It was under the 47.25 area. And then we started to fall back. We came down below the daily pivot. We came down to the unchanged level, went negative for a while, bounced up to the daily pivot, came back down to the unchanged level, and then saw a little bit of buying going into the close. Here's our intraday chart, where we were more negative in the initial pre-market session. But then after the economic reports came out, and then the ISM is kind of what gave the market that little push up. That's when we ended up turning positive, and then the choppiness, and then we ended up being pretty much flat in the session right after the market closes, and then we're closed until Sunday afternoon or evening. Here's growth versus value. This is a concern. We're seeing the blue line really underperforming the red line now. Value ended up being slightly positive, where growth is actually more negative. That is a concern, and that's what we've been seeing now for some time. And here's the S&P growth to value ratio. Also, the big spike down, and then we're seeing this continue to trail off. As the market was going up throughout December, we were not seeing a corresponding rise in this ratio, which is normally what we would see in a more positive environment. So the fact that we're seeing some weakness right now is not necessarily a surprise. The end of day charts, where growth was up, but it was up less than value for the large caps. It was up less for the mid caps, and it ended up being down for the small caps, where value for the small caps ended up being positive. And this is where we're seeing some breakdowns inside the market. The small caps, the ratio is now coming down to the bottom end of the range. We're even seeing a drop off in the mid caps. This has been an area that had been holding up a little bit better, but the last few days now, as we start into 2024, this ratio has been coming down, and we're seeing a continuation of this deterioration now with the S&P growth to value ratio, and we're getting ready to see a death cross here with this ratio. That could be negative unless the market is going to find a way to really turn and go back up. Keeping an eye on our trend, where we are below the moving average and declining, but we're still above 40. So you can choose whether you want to still count this as an extreme reading. Okay, but the green line is coming down. If we have another couple of down days here, we could actually cross over negative. Here's the short-term ADX. It is also now starting to drop below 40, and it's also below its moving average. The green line hasn't quite crossed over the red line yet. We are still below average with volume. Here's our sentiment. We're starting to pick up a little bit with the Ulcer Index, but we're still below the moving average. The VIX actually turned down on the line chart as well as the bar chart because we had the slight up day. And we're seeing volatility of the VIX also continue to drop off, and that tends to happen on up days. We're still keeping an eye on this. This is the correlation between the VIX and the S&P. We're still just about at this dashed line. That means that the market is anticipating something, and usually it's negative. If we spike up here, that would even confirm more of this signal. What we're trying to figure out now is, has enough of a signal been generated, and are we going to see a decline after that? Then looking at the equity put call ratio, it continues to go up as we saw an increase of hedging in Friday's session. We're ticking back up just slightly with our 5 period. So that's turning things a little bit more negative. And we're also going up with this other fear gauge. And the risk on to risk off ratio, it ticked back up, but lately we have been seeing this declining overall. We want to see more improvement in this chart. Saw a little bit of an improvement with the advanced decline line based on price and volume. We're still well above the moving averages, but they have been falling back recently. And we're still flat with our 5 period moving average of the new highs minus the new lows. And it's not that we're seeing an expansion of new lows, it's that we're seeing a contraction of new highs. The 10 period continues to decline. The advanced decline ratio did tick up just a little bit. We're still above 0, so this is remaining positive. We're starting to come down now. We haven't quite hit this moving average yet with the accumulation distribution. This is a smart money indicator. If we drop below this, that could suggest the smart money is selling. Another smart money indicator is the Chaikin money flow. It ticked up just a little bit, but it has been declining lately after giving us an extreme positive reading. Saw a little bit of a tick up with the NYSE cumulative advanced decline line, as well as the regular advanced decline line. This other advanced decline line did tick up, but I mean, these are just little tiny notches. We're not really seeing much improvement here. A bit of a tick up with the NYSE common stock based on price as well as volume. Our advanced decline line studies, we turned up a little bit with the common stock with the NYSE and the S&P, as well as the mid caps. We declined with the small caps. Our short-term chart, we're kind of hanging out right around this pivot point. We ended up coming down below it. We got a little bit above it in Friday's session, and we're kind of right on it right now. It's a little bit of a tipping point in the short term. On the bottom, we see where we drop to below average with volume. We're no longer extreme with the 20. We're still extreme, but coming down with the 50, and we're no longer extreme with the 200. The Stochc RSI is extreme negative. The Williams percent R is still extreme negative. The CCI 14 is extreme negative. And we're just dancing around right at the 20 period moving averages. Take your pick. Simple, exponential. Well, it's kind of dealing with both. We're pretty much right on the exponential moving average right now, where we did close down below the simple moving average. And the force index continues to be negative. It ticked up just a little bit, but we're still below zero. And we're no longer extreme with the short-term stochastic. We ticked up just a little bit. Now we're starting to get just barely extreme negative with the intermediate term, and we're no longer extreme positive with the long-term stochastic. And we're just about at the midpoint for the standard deviations chart. The balance of power ticked up just a little bit and is still above zero. So that's remaining above the midpoint. That's remaining positive. We're still more of a neutral to positive with the go, no-go system. We're right at the midpoint with the highest high, lowest low values chart. The TTM squeeze is still showing some more negative momentum as we see the darker shade of blue bars. They're blue, so that's positive, but they're going down, so that is negative. And we're just a little bit under our double exponential moving average with this chart. We thought we might be able to recapture that if we had a good solid up day. So far, the market has not been able to do that. We're dropping below zero with our ease of movement. That's turning things more negative in the intermediate term. We're still flat with the Arun, even though we remain positive. The McClellan oscillator for the S&P ticked up, but we're still below zero. So that's short to intermediate term negative. We're turning down with the summation index based on price as well as volume. That's more intermediate to even longer term negative. And the NYSE McClellan oscillator ticked up a little bit, but still below zero. That's still negative. We're starting to roll over and turn down with our summation index for the NYSE based on price and volume. We're dropping below zero with the Swenlin trading oscillator based on price and volume. We're rolling over, but still extreme with our PMO. We've already crossed below the moving average based on price, and we're actually beating that a little bit based on volume. And we're still showing more deterioration with the PMOs that are rising. We're also declining with the buy signals. We're still extreme positive with the PMOs that are above zero. We continue to be negative with the Elder's Impulse system for the S&P. We're also negative with the parabolic SAR. We're rolling over and no longer extreme with the slope oscillator. That's our short-term oscillator. We're also headed lower now with the MACD. So when we look at all of our oscillators, we're no longer extreme with the slope. We're still extreme, but coming down with the TSI. That's the short term. We're rolling over and turning a little bit more negative now with the MACD, the PMO, and the PPO. We're rolling over, but still extreme with our long-term oscillators, the TRIX and KST. And we're just still dealing with both the double or the simple and exponential moving averages based on 20 periods here. We're starting to roll over a bit with the bullish percent index, but we have not crossed below 70. We're also declining with the NYSE bullish percent index, and we're also declining with the NASDAQ 100 bullish percent index, and we have not dropped below 70. The Sean trend meter is starting to decline, but it's still positive. And the Chaikin oscillator, it has now gone more full-blown negative. We dropped below the midpoint and we continue to decline. The Bollinger Bands were just a little bit underneath the midpoint. The money flow is below 50 and declining. That's negative. The Ultimate Oscillator below 50 and declining. That's negative. This is another kind of big one. The Vortex, we're starting to see the green line cross below the red line. So that's turning more negative. The rate of change, even though it's rolling over, continues to be extreme positive. The RSI, based on 14 periods, we're still above 50, but we're below 50 based on 9 periods. So that's kind of the difference between the short term and intermediate term at this point. On balance volume, we did tick up a little bit, and we're still above the advancing moving average. We're still looking pretty extreme and ticked up a little bit with our 200 period moving average study for the S&P. We're starting to decline a little bit more with our 50 period moving average study, but it's still coming off of an extreme positive reading. Looking at our 50-day cycle, we did start a new cycle on January 2nd, and that seems to be, actually we started the Friday before, but that's really been kind of the shift that we've been seeing lately. And we're coming down to the lower end of this mini rainbow with our 20 period simple moving average of the open, high, low, close. Will this end up providing support? That's often what happens when we're in an uptrend. We come back down into this area, it hits one of these lines, and then sometimes finds a bounce up off of that. We're turning more negative with the hike in ASHI. We're also negative with the KEGI. We still continue to be positive with the Renko, and we're turning more negative with the 3-line break. We're still extreme positive with our 150 and 200 period moving average study, but they are coming down. And we're still above this longer-term trend line on the weekly chart of the S&P 500. And we're just a little bit under the trend line with the NASDAQ 100 weekly chart. And we saw a little bit of an improvement here with the equal weight index. It's been doing a little bit better than the mega caps. And our ratio came down just a little bit, showing that the equal weight slightly outperformed the S&P 500 weighted index. This is another big negative divergence that we've been watching. We were actually up with the Dow on Friday. We were flat with the transports, but we're seeing a big negative divergence here as the Dow was going up, the transports were not. And we ticked up just a little bit with the utilities. So the transports are still underperforming the Dow. The Dow seems to be hanging in there, at least for right now. It's not necessarily falling apart at this point. The diamonds still remain neutral after having been positive. The NASDAQ, that's where we're seeing a little bit more weakness. It's a little scarier looking chart, even though we were up in Friday's session. And the NASDAQ 100 also was up on Friday after seeing a bit more of a decline. The Qs still remain negative for the Elder's Impulse system. On a momentum basis, the NASDAQ 100 continues to be negative. The small caps, we're coming back up to this pivot point now. We're just a little bit below that. We saw the really explosive move up and then a lot of give back. We're wondering what's going to happen next. We still remain negative with the small caps for the Elder's Impulse system. We're still below this support level with the Russell 2000 small caps. We're dropping below 50 with the RSI. We're also turning negative with the momentum after recently giving us a golden cross. It's like, can these things ever line up when it comes to the small caps? It doesn't seem to work that way these days. The mid caps are just a little bit underneath the pivot point after giving us a recent golden cross. We're still negative, though, with the Elder's Impulse system. The financial sector is still hanging in there. It was up almost 0.5% and continues to be in an uptrend. The FANG index was up over 0.5%, and it's still above its 50-day moving average. The dollar ended up ticking down just a little bit. It had been seeing some more recent weakness as the market was going up. It's now been going up as stocks have been under pressure. Then with bonds, we ended up going up with the 10-year yield. We were down with the 10-year based on price. And then this historical chart, this will be the last time I show this, and I'm going to switch it over to the weekly video. This just shows that when we spike up and then hit some kind of an extreme reading with the 10-year yield, oftentimes, but not always, this marks the beginning of something kind of bad that happens for the market. We don't know what that is, if even anything is going to end up developing. Then looking at our growth to value ratios, we're still showing weakness with the Qs to S&P, as well as discretionary to the S&P. Large cap growth is underperforming large cap value. So our growth to value ratios for the large caps, mid caps, and small caps are still showing weakness. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We're dropping, but we're still positive with our highs minus the lows. And then we take a 5-period moving average and spread that out across the broad market. It's coming down, but we're still maintaining a positive number there. We're ticking down just a little bit with our 50-period exponential moving average of the new highs minus the new lows. So what's our outlook for Monday? Is the January effect over? It's really being brought into question right now. It seemed like it was a done deal a week ago. Now it's like, okay, the small caps have been falling apart pretty much since the beginning of 2024. Where's this magical January effect? The Santa Claus rally didn't happen. Is the first 5 days, is that going to happen too? That'll be decided on Monday. And then what's going to end up playing out for January? Isn't this an election year? Aren't things magically supposed to go higher? See, this is the kind of doubt that the market likes to throw at us. The technicals are positive, but we are seeing weakness developing, and we're dealing with that 20-period moving average. We will get consumer credit on Monday, and then we're keeping an eye on the different geopolitical events. Here's the economic calendar. We're going to get the trade balance on Tuesday. We're going to get the really not much on Wednesday. The big one is going to be Thursday with CPI as well as PPI on Friday. Those are the two big inflation reports. Seasonally, for January, December 8th, we're negative for the Dow, quite negative, where we're neutral to negative with the S&P, and we're flat out positive with the NASDAQ. So you think the market's a little confused right now? We will be on the 5th trading day of the month, where during an election year, we do tend to see some weakness here. That's the green dashed line. We're wondering if the January effect, it seems elusive now, where it seemed like a done deal just a week ago, but we're wondering if that's going to come back into play. And then I'll probably delegate this over to the weekly chart as well. We're just wondering if 2024 is going to play out in a similar fashion to what we saw developing in 1982. Here's the seasonal chart during an election year where we do start off pretty choppy. That's the dark blue line. And we are also choppy when we look at the Stock Traders Almanac statistics. But when we look at the times when the sitting president is running for re-election, that ends up being more positive. And we're not seeing that yet. And then Monday ends up being the most positive day of the week. It's, at least in 2023, it was showing pretty good results. And then for the month of January, since 1950, during election years, we have a 50-50 split. So our scenarios, we really can't go with the down one, even though we are seeing more weakness. We're not seeing an awful lot of confirmation. There's still support that we're dealing with. There's still more positive things in the background, and we haven't actually switched over to a real negative stance. It's hard to go with the up one, but we still are leaning towards that because our charts, they're still leaning towards the positive side, but we are seeing some weakness start to come into the charts. We're still concerned about the sideways trend because especially the intermediate term ADX is still above 40. The warning signs, this is a concern. Growth is showing weakness, and it's been underperforming. It didn't seem to matter when the market was going up. Now it's like the market is suddenly paying attention to that. The risk-on posture is showing some rather short-term weakness after it had been showing an improvement. The transports are negatively diverging from the Dow. The 5-period equity put-call ratio is just ticking back up slightly. The vortex has now crossed over negative. The 1 to 3 month, I stopped showing that chart. It continues to be positive where it should be negative. The parabolic SAR is negative. The Coppet curve is negative. Our oscillators, they're rolling over and starting to head down, but they're still extreme positive. The NASDAQ 100 momentum oscillator, the PPO that we look at, is negative. The positive signs, our daily special K chart is positive. The longer-term equity put-call ratio is positive, which means it's going down. The bullish percent index, it's still above 70, but it's starting to come down. The Zohorchak method has not changed. It went from being negative to neutral. The Russell, the small caps and the mid caps are working off of recent golden crosses. Small and mid cap growth is still positive, but chopping sideways. The financial sector, it's one of the better looking areas right now. And the new highs, new lows study based on 50 periods for the S&P 500, that continues to be positive. So our conclusion, we are still positive for right now, but weakness is creeping in. In the short term, we are seeing weakness, and we're right at the 20-period moving averages. That's the short-term moving average. If the market is going to be able to bounce off of this short-term pullback, we're going to need to bounce above the 20-period moving averages. If we lose that, the next logical area would be the 50-period moving averages. And we are showing some more weakness in the intermediate term. We're still holding up okay for right now in the long term because we're above the 200-day simple moving average. So thank you. I hope you have a really nice weekend. I will be preparing the weekly video, the intermarket analysis video, and the deep dive video. I was going to do a couple of supplemental videos, but the whole scenario changed. I thought that I was going to be pointing out the divergences that we're seeing in the transports and growth, and the market was going to keep going up. Well, since the market has not been going up, I kind of had to rethink those videos. So have a great weekend, and I will talk to you in the next video.